was, I just have a short introduction.
Do you need to turn this on somehow? This mic?
Unmute.
1, 2.
Hi, good morning everybody. So thanks for coming to this guest lecture. So I'll just have a few words and then I'll leave the floor to you, right? There's many things to say about digital currency risks and opportunity. So Euro is first of all a friend since the PhD. We did PhD together and colleague. Now we work on project together. So I kindly ask him to come and deliver a guest lecture about this topic, which I hope is of interest of you, given it's very trendy and recent. So I leave the floor to Juraj. Please interrupt him at any point with any question, even if it's just a curiosity. Just do it, and then we'll have like a short session at the end of the talk that you can ask more questions. And it will be available in C40 in Charles Carter if you want to talk to him. All right? Thank you. The floor is yours. You know the timing.
Thanks. Can you hear me with this?
Yes.
Okay, good. So nice to meet you, everyone. My name is Juraj, and today I will tell you something about digital currencies. So first of all, I will tell you something about how I got here, what I studied, where I worked, because Roberto told me that this is something which is potentially interesting for you, for your future career prospects. I will then tell you briefly very basic intro into crypto, basically into Bitcoin, how it works, why it's interesting, how it's different from traditional financial system. I will briefly mention central bank digital currencies, and if I have some time in the end, I will also tell you what we are currently working on at the European Commission and how is it relevant to digital finance or digital currencies in general. Sorry, my voice is not so great. I was sick recently. I'm still getting over it. If you don't hear me, please shout, and I will try to be loud. Okay, so first of all, I obtained my master's degree from mathematics in Slovakia. And after getting my degree, I wanted to also do something more applied because mathematics was a bit too pure for me. So I decided to do a PhD in finance with Roberto here. And I was lucky enough to work with an excellent advisor. So if some of you are, for instance, considering going for a PhD, I really cannot stress enough the importance of your supervisor. So make sure that your supervisor has time for you and that the person is really also invested in what you're doing. The PhD was in finance, and I was focusing on a topic which was called systemic risk. Systemic risk is essentially trying to understand the banking system, as a complex system with some dynamics. Because after the crisis of 2008, we invented the Basel regulation, where we sort of force the banks to hold some capital buffers. Now, if you look at this purely from this Basel perspective, you look at the banks as individual entities. If you look at it from the systemic risk perspective, you look at the system as a network of interconnected nodes. And then if something happens to one of the banks, you study what is happening in the complex system, how this shock propagates to the rest of the network. So this was very interesting also for the European Central Bank, which is how I managed also to get a traineeship at the ECB. So for instance, if you consider working at a regulatory institution yourself, it really helps if your research or if the work that you have been doing is connected to the current topics which are interesting for the regulator. In that time, in 2018, 2019, it was systemic risk, it was financial networks, it was contagion in this complex system, how it develops. After the ECB, I went to 2 other national banks. One was in Austria, the other was in my home country in Slovakia. And in parallel, I was also consulting on some bits with the Ministry of Finance in Slovakia, and I was also doing some lectures in game theory in my home university where I did my master's. Now, since 2 years ago, since 2022, I moved to Italy, where I work for the European Commission as a full-time researcher. And I mostly focus on digital finance, and from then mostly on digital currencies and on crypto. So how does it work, or how does it feel to work at the EU institutions? So what I can tell you is, I can tell you something about the ECB, something about the national banks in different countries that I visited. I can tell you how the work at the Commission looks like. because I heard this is something you would be interested in. So first of all, with the ECB, the good thing is that you really are at the center of what's going on. You're really at the center of policy creation. You really see firsthand the people that are working on the new policies, on the new regulations. And in this sense, it's a very inspiring place to be, because you sort of understand what will be the big topic in 2 years, what will be the big topic in 3 years, because this is what is being discussed in meetings, in conferences, in workshops when you are there. That said, ECB is an extremely competitive environment. So if you have to be really driven, you have to be really good, and you have to be ready to compete with really, really good people from all over Europe who all want to work and who want to, give some impact, produce something at the ECB. I was able to spend almost 2 years at the institution, and my own output was I was contributing to the network models of systemic risk, which I mentioned before, and the output that is currently being used, as far as I know, still is a set of models which are looking into the overall dynamics of the financial system, and which are looking into contagion from one bank to another in terms of bankruptcy. If you have any questions, of course, feel free to stop me. As Roberto said, feel free to stop me anytime. Then I can tell you something about the national banks in Europe. So I worked at 2 different national banks, one in Austria, one in Slovakia. Both of these banks are part of the Euro system, are part of the system of the European central banks. And even though they are not directly in charge of monetary policy, of setting the interest rates, because this is the ECB's job, they are still doing a lot of their own work. For instance, they do a lot of work with their own individual commercial banks within their countries in terms of supervision. They're also doing a lot of workshops on financial literacy. They do their own research, own statistics on many different risks, which are maybe country-specific. For instance, right now I'm still collaborating with the National Bank of Slovakia on this project on flood risk, where we try to understand how a flooding of a given region in Slovakia can potentially hurt the companies which have production plants in those regions, and then how this can potentially affect the banks which have provided these companies with some loans before, which is a project which is extremely specific to Slovakia, because the risk of flooding of very crucial areas is quite high in this country. If you want to work for these national banks, you will be rewarded with a pretty good job security, pretty good work-life balance. If you compare it to the ECB, where you work 12 hours a day, every day, in a very competitive environment, it's a little bit of a different mindset. So it's also a little easier to get into as opposed to the ECB. For my output at these institutions, so at the Austrian National Bank, I again worked on something which was systemic risk related. I was working on this data pipeline which allowed the bank to input this very, very specific data set and run some models on it. And for the Slovak National Bank, I worked on a project which was focused on strategic asset allocation, which is basically portfolio optimization. So the idea is that even though it's a central bank, it still holds some position in terms of different assets. For instance, it holds some stocks, it holds some gold, some commodities, bonds, etc. And this is like a legacy asset portfolio which has been there since the 90s. The thing is, when I joined the bank, nobody really understood what assets they are holding, what are the correlation between the potential returns on these assets, and etc., etc. So roughly at the time when I joined the bank, the board decided to set some investment preferences, which basically meant that they said that our bank should optimize the expected shortfall over some specific horizon, over some specific level. And then they came to us, researchers, to formalize this very generic idea. So they said, well, we want to optimize the shortfall. You guys write it down in terms of formulas, and you tell us what is the optimal portfolio, what we should hold. So my output was basically a model which allows you to take these pretty non-standard preferences, investment preferences, because it's a central bank, so it doesn't really have a standard investment preferences, and output an optimal portfolio allocation that they can hold in terms of this, they call it strategic asset allocation, or SAA. If you want to see how it works, we can also talk later, because the final output is actually a graphical user interface where you can also click what assets you want to combine, and then it gives you the whole portfolio. It shows you the expected returns, the correlations among the assets, and everything. If you're interested in that, let me know. We can talk. Okay, and the last but not least, so since 2 years ago I work for the Commission. I work for the Commission's Research Center, which is one of the directorates of the European Commission. The European Commission has many directorates which are mostly based in Brussels, and these are everything you can think of. So for instance, there is a directorate which is in charge of finance, economics. There is a directorate in charge of energy, in charge of defense, in charge of many different topics, and general topics. We are one of the directorates. We are in charge of research. And if somebody in Brussels, a lawmaker, a policymaker, needs an analysis which is technically difficult to do, because most of them are lawyers with a law background, then, what they do is they call us, and we set up a project, usually over a period of a year, over 2 years. We have this thing which is called AA, Administrative Agreement, and we act as sort of policy advice to these regulators for them to understand the numbers, for them to understand how to quantify some effects. The good thing about this is that it's a really interdisciplinary environment. So our site, which is close to Milano, is about 2,000 people. It's a really big research site. Having 2,000 researchers in one spot is not really common in Europe. And the good thing is that if you want to start a project which is interdisciplinary, for instance, if you want to look at crypto, you need people who are good in finance, good in economics, who have some statistical background. You need data engineers. You need data analysts. Because for this project, if you miss one of those, you just cannot do it. So that's also the reason why I joined, because when you work at the National Bank or when you work at the ECB, you are working with the economists. You are working with people with background in finance. There might be some statisticians here and there, but if you want to start a project which is focusing on something groundbreaking, I mean, I don't know if crypto is still groundbreaking, but something, let's say, topical, it's sort of difficult to do within the confines of the traditional institutions. So if you are interested in that, if this is something you would like to see yourself doing in the future, we can also talk about that. So hopefully the output, I'm saying hopefully because we're still working on it, is a project which we call CIPHER. And this project is supposed to work as a crypto analytics framework. And if I still have time at the end, I'm happy to tell you more about it. How much time do I have, Roberta?
There is a clock there, so in front.
Half an hour, right?
Yeah.
Okay. All right. So let me tell you something about Bitcoin. So just because this is supposed to be a lecture, so might as well that you learn something. So if you really want to learn something about Bitcoin, go to this site. It's learnmeabitcoin.com. It's the site from which all my figures that you'll see today are going to be. This guy, very nice guy called Greg Walker, created this site as just for teaching people how Bitcoin works. And he was very nice enough to allow me to use his figures during this presentation. So if you want to use Bitcoin, it's very easy. You go ahead, you download the program. This program is, in 96% of the users, it's Bitcoin Core. You run this program usually on a Linux operating system. And the way this program works is you install it on your machine, you connect it to the internet, and then what happens, it connects to the Bitcoin network. So it connects to all the other nodes who are running this software on the network, and it starts receiving a shared file, which is called a blockchain. Once it syncs, once it receives the file, which is currently about 700 gigabytes, so it's quite big, you are up to date. So you see all the transactions from the inception, I think 2009 roughly, from the first transaction on the Bitcoin network. So how does it work if you want to insert a transaction into the network? So what you do is you insert the transaction into one of the nodes. You send it to one of the nodes who are managing the network. And then this node propagates in the network. So the node sends it to other nodes which are in the network. And then what happens is that one of the nodes, they add the latest transactions onto the blockchain, onto the file. And then this file, this new blockchain, is shared with the rest of the network. So you have two things. You have one, like empty transactions which are floating around, and then you have the blockchain, which are the fixed transactions which have already been memorized by the network. And one of the nodes switches the transaction from one to the other. So what happens if you try to double spend? Let's say that you have 1 Bitcoin, and the green transaction says, I am paying this 1 Bitcoin to a local pizza place, and they give me a pizza for my Bitcoin. Maybe that's not the best deal now, that seeing that Bitcoin is 60,000 euros, but let's say that it's roughly the value of a pizza. So you send them 1 Bitcoin, you get a pizza. But let's say at the same time you send the same Bitcoin to another restaurant, and you get a burger for your Bitcoin. Now you send both of those transactions to the network, one to the node over there in the left, one to the node over there in the right. Now they start to sync the transactions along the network, but there is a clash because, for instance, the node in the middle now receives 2 transactions with the same Bitcoin. He sees that you want to buy a pizza and you want to also buy a burger with the same Bitcoin. So what it does, it rejects the transaction, one of those transactions, because then if you could spend your Bitcoin twice, then that would break the system. So the thing is, how do you do this? So how do you choose which node does this? The way you do this is that randomly, every 10 minutes, you choose a random node who is doing this distinction of which transactions get written on the blockchain and which transactions are just floating there in this thing which we call the mempool. So let's say it's this random node. So once it receives 2 conflicting transactions, the node can choose which of the transactions it puts onto the blockchain. Now, how is this done? Why are the nodes incentivized to do this? Well, the way it works is you have something which is called a hash function. A hash function is a very complicated thing, which I will not explain here because we don't have time, and it's also not that interesting from the economics point of view. But you can think about a hash function as this black box, and whatever data you put inside, you get a random number for this data. So you can, let's say, put your favorite book as text, you put it into the function, which is 1 megabyte or something of pure text data, and the output is going to be a random number. That's the hash function. The property of this hash function that is very important is that if you change this data that you put inside by a very, very small amount, so you change 1 letter in this whole book that you put in, then the random number will be completely different, completely different. And there is no way to predict which number this is going to be. And this is a really crucial thing to do. It's not easy to do a function like this. You need some very, very complicated mathematical structure to create a function like that in the first place. Sorry. So what do you do? How do you use this hash function? You use this hash function when you're creating the new block on the blockchain. When you are one of the nodes who is choosing which transactions to add, what you do is you select some transactions that you want from the mempool. You put them all together. You can call it a book. So it's basically a bunch of text containing transactions. You take the previous random value from the last block, which is also a result of the hash function from the previous block. So you take that, you merge it with these transactions, and what you do, you add some random number, just really random. You generate a random number however you want, and you add it to that. So you have these 3 things, potentially some other which are not important that much. And once you do these 3 things, you hash them. You put them into this hash function, and you get a random number yourself. Now, this is how it works. So you take the mempool transactions, you put all these other things I mentioned into the box, and you get, let's say, this really long number. Now, if your number that you get like this is small enough, so for instance, if the target that you're looking for is 1,000 here, your number, which is this really big number, should be less than 1,000. So it's really unlikely to get that. So what you do is you rehash. You do it repeatedly. You always change this small random number that you put inside the box, and you always get a completely different number as an output because that's the property of the hash function. And you do this until you get a number which is below this target. And when you get that, you found a new block. So the protocol agrees that at this point, you are the ones who can add this new block onto the blockchain. And that's how it's done. That's Bitcoin, basically. Because if you can do that, then you can have a very good system for incentivizing the nodes to work together on a very difficult mathematical puzzle. And the puzzle is scalable. So if you have a lot of computation power in the network at the same time, a lot of people are trying to find this number which is below the target, which we call mining. Then what you do, you change the target. And you do this every roughly 2 weeks or every roughly 2,000-something blocks. And when you do that, you change the difficulty. So suddenly it's more difficult or less difficult. And the system is automatic, and it's set such that the expected time to mine a new block is 10 minutes. So if for the last 2016 blocks, the time was 9 minutes, you increase the difficulty. If the time for the last 2016 blocks was 11 minutes or 12 minutes, you decrease it. So once you do that, once you are the ones who are successful in getting the mining process done, in getting the below target, you get a reward in terms of bitcoins. Initially, in 2009, the reward was 50 bitcoins. So for every block that you were able to find, you got 50 bitcoins. Now, every 210,000 blocks, which roughly corresponds to every 4 years, this reward is turned into half of the previous amount. So it was from 50 to 25, from 25 to 12.5, and I think now we are just a little over 3 bitcoins per new block mined. So if you can solve this puzzle, you can try every 10 minutes, you can try again. You get 3 bitcoins, which right now is, I think, a little less than 200,000. All right, so what happens if you decide to mine, but you decide to mine not on the last block, but you decide to mine on the block which was a previous block? Well, the consensus of the protocol is that you always mine on the longest chain. So if someone can give the longest chain, then this is the chain which is accepted by all the other nodes in the network. But still, it can happen that, for instance, you have the network, and that at the same time, roughly same time, before the update can happen, 2 different nodes solve the puzzle. If 2 different nodes solve the puzzle at the same time, then what happens is that the blockchain will fork. And then now you have 2 parts of the network. One part is synchronized to the left, one part is synchronized to the right. And there is now a competition happening. So some of the nodes are mining on the left chain, some of the nodes are mining on the right chain. And whoever wins, so whoever is able to solve the puzzle or find the new block first, that's the block, or that's the chain which also the other half will now use from that moment. Now, what this means is that there is a potential way to attack the network. And the way to attack the network is, if you have a lot of money and a lot of computational resources, what you can do is you can try to get majority of the computation power in the network. So let's say you manage to get 51% of the computation power which is used to mine the new bitcoins. If you can do that, then what you could potentially do is rewrite the history. Because you go back in the blockchain, you can go 100 nodes, 100 blocks. And you say, okay, now I'm going to mine not on the latest block, but I will mine on the block which is number 100 in the past. If you do that, if you have more computational power than the rest of the network, then your chain will at some point be the longest chain because you have the most computational power. And once that happens, all the other nodes will switch to your chain because that's how the protocol works. And no one can change that. That's the agreement. So in a way, if you were a small country which wanted to do this attack, it's potentially feasible. No one has ever done this because we would see it in the blockchain itself. We would see there was a fork for 100 blocks or something, or even more. So usually I think the longest fork that we've observed was maybe 4 or 5 blocks, while 2 sides of the network were competing at the same time. Yeah, exactly. So how do the bitcoins themselves look? So what is it? How should I understand it? Suppose this is the blockchain, and suppose that the block which is on the top is the most recent one, and the one on the bottom is 2 blocks in the past. Now, in each block, you have these things which are called outputs, which are essentially bitcoins. And the way it works is when you mine some new bitcoins, when you are the one who managed to solve the puzzle, you get to choose where these bitcoins go. You can send it to another address. So you hold the key to unlock these bitcoins. So for instance, in this case, if you were able to mine this, you are able to unlock it, and you are able to send it to another address, which is then locked by the person who is holding these bitcoins next. And if you want to, let's say, only send 8 bitcoins out of the 10, you can lock the rest of it to yourself. So this is called a change address. So it's usually a new address which is generated, but which you yourself hold as well. And you can chain these transactions. So this is how the payment system works. So initially you start with 10 bitcoins, you send it to your friend. They receive 8 bitcoins, you keep 2 to yourself. Then they can take these 8 bitcoins, they can send it to someone else, etc., etc. And whenever you want to send a bitcoin, it means that this transaction has to be added to the blockchain. So it's always the new block. It's always the next block which is being used. This is a very nice way to visualize it. So you start with this big gray box, and then you slowly send some bitcoins which are always in the next block. If you want to, for instance, create a new output which is bigger than the ones from before, you can also have multiple inputs in one transaction and just have one big output which is locked to yourself. These outputs are called UTXO, or unspent transaction outputs. And if you want to learn more about bitcoins, just Google UTXO, and this will be easy to understand. So how do the accounts work? How do you know where to send it? How do you know who holds it? So this is again done using cryptography. The way it works is you take a random number, again, which is called your private key, and you use a standard cryptographic techniques to generate something like a public key. So what happens is that your private key is something like your bank account password, and your public key is something like your bank account number, so people know where to send you money. In this sense, you can always give someone your public key, just like you would give someone your bank account number to send you money. And you can always lock some bitcoins to someone's public key. So everybody agrees that nobody can use these locked bitcoins unless it's a person with this specific public key. But no one can send them without entering the private key that they have. So it's a pretty good system, and it's all based on cryptography, again, just like the mining. Yeah, exactly. If you want to send a particular UTXO to someone, you use your private key to generate something which is called a digital signature, which is like a one-time token that allows you to send this particular UTXO to someone. And this is all together. So just to repeat what I just mentioned in terms of Bitcoin, the way it works. So first of all, you generate some keys. You and your friend both generate keys, a public key and a private key, so you know who to send to, and you have a means to send it. You can generate a digital transaction, and then you insert it into one of the nodes in the network, into the mempool, which is this magical place where transactions are floating around and none is assigned yet. Then one of the nodes wins the competition roughly every 10 minutes and manages to find a new block with the given set of transactions, adds these transactions onto the blockchain and shares it with the rest of the network. And rinse and repeat next 10 minutes, similarly like that. So this is it. This is very naively speaking how Bitcoin works. If you want, you can buy Bitcoin by logging into an exchange site like Binance, for instance, and there you can just send some fiat currency like pounds or euros, and you get some Bitcoins in return. But in the end, what happens is that this Binance, for instance, this service, they just create all of these wallets for you, and they manage this for you, so you don't have to do it yourself. If you wanted to do it yourself, You could still go to somebody you trust. You give them £100 cash, and they give you a private key on a piece of paper, and you can also buy Bitcoin this way. So it's a payment system which doesn't require trust. And that's the key point. So if we should summarize what we've discussed about Bitcoin right now, the most important part that you should learn is that there is no central authority. There is nobody backing up the Bitcoin. There is nobody deciding how many new Bitcoins will be emitted. No, nothing like that. You just have a protocol. And in this protocol, you have a bunch of players who are incentivized to work together on this system. They are incentivized by very complex cryptographic properties of the hash functions. And nobody is really willing to deviate from the system unless you would be the attacker who has more than 50% control of the network. So unless that happens, you have a system which works pretty well for transferring money, albeit it has some drawbacks in terms of scalability, in terms of how fast it can process transactions, et cetera, et cetera. So the key here is really the cryptography. The key is you have these public and private key pairs for signing and receiving the transactions. And on one hand, and on the other hand, you have these hash functions which allow you to produce a random number, which is very different depending on the output that you put in. If you didn't have that, you couldn't do it. Right now, you have 21 million Bitcoins that are supposed to be mined until about year, I think, 2140. Over 90% has been mined already, and 10% of this 21 million is still to be mined. So you could think about it as inflation. As the central bank would send the interest rates and would try to target inflation, this is the Bitcoin analogy of inflation. So you halve the value that you receive every 4 years. So there is some implicit inflation written in the protocol in the first place. Everything is transparent. Everything is on the blockchain. If you buy your pizza today, it will be there in 100 years if we are still here. And everything can be downloaded directly by anyone on the planet. It's backed on every single full node, and there are thousands of full nodes right now on the network. It's also very robust against censorship. If you are in a third world country which is going through a turmoil, you don't, yes?
Just one second.
So if the fixed supply is like 21 million Bitcoins, so everyone is mining because they get a Bitcoin at the end, right? And the Bitcoin has a value. So when even though it's like in 100 years maybe, but when it's going to happen, when like the fixed supply of Bitcoin is going to be reached, why people are going to still mine it if they're,
Excellent question. Thank you. So this is a really good question. But something which I didn't mention because I really didn't have much time is when you get a reward, so when you solve the puzzle, when you mine the new block, you don't just get this right now 3-point-something Bitcoins. You also get transaction fees. So if you want to add a transaction to the system to be sent to your friend or to your pizza place or wherever, you also add a small number, you set a small number of a transaction fee, which you are willing to pay to the miner for doing the transaction in the first place. So when the miner decides which transactions they want to add to the new block, they look at the ones with the highest transaction fees. So if you really want your transaction to go through, but you put a 0 transaction fee, it will most likely never reach the next block because nobody will add it. So even though in 2140 or whenever that happens, there will be no more Bitcoins mined in the traditional sense, you will still get some value from the transaction fees. So most likely what we will see is that less people would participate, I mean, if we ever get there. But in the end, you will still have an incentive to mine because you will have some transaction fees transferred to you. Okay, so that's it about Bitcoin. Yeah, so one last point, it's quite robust against censorship. Everything is backed up. So if you are in a third world country and you need to receive money from your relatives or need to send money to someone, it might be possible to do it via crypto because nobody can censor it at the moment. So that's Bitcoin. That's crypto. And I don't have much time, so I will just jump directly to central bank digital currencies. So what are central bank digital currencies? Well, they are digital currencies issued by central banks, which, yeah, is a surprise for sure. In a way, you should think about it as a digital form of your fiat currency. It's a digital form of potentially of pound, of euro, of dollar, or any other currency you can think of. And the difference to crypto is that it's centralized and the supply is controlled by the central bank. So it's, in a way, it's backed by the government, and it's not a decentralized system where people just agree on a protocol and they follow the rules to have a payment system that they agree on. You already have some examples. For instance, in China, you have the digital yuan. In Europe, we are having long discussions about digital euro, which is in development. And at the moment, we are still discussing the particular schematics and the particular application, how we will do it, many different aspects. So there are multiple countries which are considering this. For instance, Bank of Canada is also developing a digital euro, digital currency, etc. I think I saw this nice map where you show where you could see the whole world, and there were indeed a lot of countries working on digital currencies right now. So why would you do it? Well, if you look at the official public relations posts or the official versions of the institutions, there are multiple reasons. So, for instance, you have enhanced payment efficiency. You can get faster, cheaper transactions that go directly through the central bank. You can get higher financial inclusion. So, for instance, if you have a population which is underbanked, where some of the people just don't have access to bank accounts, if you would just have a digital currency based on an app in your smartphone, you wouldn't have to go to a traditional bank to use the banking products. You would go directly through the central bank. You could have more effective monetary policy from the central bank perspective, because you could target the interest rates directly with the population. You don't have to target interest rates with the commercial banks in your country. You do it directly with your digital currency. You can even make it programmable to allow you to only pay for specific goods and services. You reduce the risk of bank runs, because you have less money routed through the traditional banks, more money routed directly through the central bank. You have a higher traceability, you have more transparency, because you see directly the transfers going through the regulator, so you don't have to go through a regulation like AML or KYC, know your customer, and anti-money laundering. You just directly look at the transaction as the policymaker, as the regulator, you see what's going on. Support for innovation, reduced transaction costs, all of this could also be potential advantages. But in the end, something which you will probably not read online when you look into advantages of the CBDC, and one of the reasons that this is actually really happening is that it's a race right now. So if you think about this from the central bank perspective, it's really risky if you have your population that is not using your own currency. For instance, if you have a population that heavily starts using Bitcoin, Ethereum, or any other crypto assets or stablecoin for their transfers, then you lose a lot of your monetary policy influence. Because suddenly you have people trading in Tether or trading in a foreign CBDC, which they have access to, and you change the interest rate on your own currency to influence inflation, but nothing is happening because nobody is using your money. Nobody is using your currency. So it's a problem. So one of the reasons why central banks around the world are really looking into the CBDC is to be there first and to try to combat this possible impact that crypto and other CBDCs of other countries could have on your own financial stability and monetary policy. So if you would issue a CBDC as a country, this would allow you to control the money supply and keep conducting your monetary policy the way you used to until now. And it also allows you to counter the rise of these decentralized digital currencies like Bitcoin. So I think that's it. I think I have 5 minutes, but I wanted to also tell you something of what we work on, but Roberto told me that we should also leave some time to questions. What do you think?
Let's say you have
Yeah?
2 minutes. And then
Okay,
we'll
okay.
switch to questions.
Sounds good. So, what do we work on at the Commission in terms of this digital finance, in terms of crypto assets in general? So we have this project which we started about a year ago, which we called CIPHER. It's called CIPHER. It's a shortcut for crypto intelligence platform for a holistic European regulation. And the reason that we started this project is that if you look at the crypto landscape, what is going on right now is everything is very opaque. You don't really understand who are the entities that are trading in these transactions. What are these transactions used for? Is it mostly illicit activities, or is it also regular transactions between parties that are exchanging it for regular legal goods and services? So if you look at the overall crypto landscape, you see that there are many problematic things going on. For instance, there was the FTX exchange failure, which happened recently. There was also, maybe you've seen this. If not, this is quite an interesting example. It was this Terra Luna token failure, where you had Terra and Luna tokens which were bound together, and they managed to plummet to zero in the matter of a very short time. You have also other examples. So for instance, there was this one coin where nobody really understood how to withdraw their funds once they inserted the money into the coin, and it turned out that it was not really straightforward. So at one point, the issuers of this coin have pulled the plug and stolen all the funds of the people that put their money into this coin. So there is a lot of questionable stuff happening in this world. So we as regulators, or we as policymakers, we need to better understand the system. We need to better understand what is going on, who are the actors, what are the rules, etc. There is a recent regulation in Europe which is called MiCA, Markets in Crypto Assets. And this is a regulation which allows you to monitor the issuers and the service providers behind the crypto ecosystem. You see, you have a much better outlook into the exchanges and into issuers of the respective coins. But there is still very little that we know about, for instance, the ties between the traditional financial system and the crypto ecosystem. We don't know how much traditional banks hold in terms of crypto. We don't know what would happen in terms of systemic risk, for instance, if one of the crypto assets were to go down very quickly, how this would affect the traditional banking system. So we struggle. And if we look at some private solutions which should give you this information, it's very difficult to talk to them because they don't want to share their data for business reasons. And also, they are not focused on this holistic view where we understand what is going on to the system. They are more focused on this individual view. So what we are working on is we have a team of data scientists, data engineers, of people who are really good in network protocols, in computer infrastructure. And we combine this with people from social science. So we have economists, people from finance. And we are working on developing an infrastructure that allows us to analyze this world better. So right now, we are working on combining the blockchain data. We started with Bitcoin. Now we are working a bit on Ethereum. And we are combining it with off-chain information that you could potentially have in a single data warehouse. In the end, we want to have a web interface which would be accessible to anyone in Europe or anyone anywhere for that matter, where they could have a real-time analysis of the crypto market flows. And you could basically understand, hopefully, also some cross-border flows between the countries, which is, by the way, really tricky to do because you have no idea what's going on inside. Yeah, so that's it. We want to look at the geographical distribution. We want to look at the sectoral allocation. And I have this chart which shows the data warehouse and what goes in, what goes out. So in the end, if you are successful, this will be the end product. Okay. I think I'm on time, right?
Yes, you're perfect.
Very good. Okay. So, if you have questions.
Yes, please. Do you have any question to you?
Yeah.
Yes, just one second.
So I saw a statistic, and I don't know if it's correct, but there's a lot of crypto-based crime. There's a lot of crime that is funded by crypto, and obviously that's quite a bad thing. But what are the limitations in regulation that could be implemented in the future?
So, right now, you have specialized blockchain analysis companies who are basically working on these questions. There is this one company which we also worked with, or tried to work with, because they are very hard to talk to. They are called Chainalysis. They are, I think, the market leader in this world. And the way they work is they really scrape the whole blockchain, and they combine it with some off-chain information to understand how the transactions are propagated. So let's say that you are the bad guy and you stole some crypto from someone. So for instance, you installed a malware on someone's computer. It's a ransomware, so they have to pay you 1 Bitcoin or half a Bitcoin or something. Otherwise, their computer is locked and they cannot access the files. So the way this works is you send some money to a wallet address, and then this company, they trace where it goes next. So it looks at the blockchain because everything is public, and they see, okay, so this address unlocked it to another address, that address unlocked it to another address, and it ended at an exchange. And then what you do is you make a court order, you send it to the exchange replies usually within hours, it's an automated process, and then the exchange actually has to give you the account number and the details of the real world person who has withdrawn the funds from this account. So there are ways to combat some parts of it. Even if you would think that you're anonymous using Bitcoin, if you are not really, really smart about it, then a company like Chainalysis will be able to track you. So if you really want to be smart about it, you use a VPN, you use Tor. When you transfer your coins, you use something which is called a Bitcoin mixer, where you put a lot of coins from different sources and in the equally distributed output. So it's very difficult to track where it comes from, where it goes. But unless you do this, it's really difficult for you to not be spotted. For instance, they told us about this one story where a guy was really eluding them for years with doing a lot of cybercrime. They could identify the addresses because you can always see where the Bitcoins go in the first place. And then they couldn't catch him. But once he forgot to turn on his VPN when he was logging on and sending some transactions. And he was watching some Netflix on his account. So they were able to pair it to his Netflix activity, and they got him, I think it was with the FBI in the US. So there are ways to combat this. Now, with the question on how to do this in terms of regulation, I think that if you look at the statistics, the illicit activities are 3% of the transactions now. So even though in the media you hear, yeah, so these crypto assets, they are used, only criminals use them, it's 3%, really. Right now, it's 3%. That's the data. It's not that much. In the absolute amount, it's quite a lot. But if these guys are really smart, if they don't watch Netflix while the VPN is on, VPN is off, and if they don't, if they do follow these security precautions, it's very difficult to trace. In terms of regulation, one of the reasons for our project that we work on for CIPHER at the Commission is exactly to understand what's going on, so we can potentially put stricter regulation on some players like banks or some players which are crucial in the vital world, in the real world, such that we have a better idea of what's going on. But we have to start somewhere, so that's what we're doing.
Thanks. Maybe we have time for another question. If you have. All right, then you? No. Thank you, Juraj.
Sure.
Thanks
so
a lot.
I'm here for the rest of the day. So
Let me remind you, you case you want to talk, if you're doing a thesis about that, you will be sitting at C40 at Charles Carter Building today, basically. All right? Thank you.
Thanks, everyone.